It's tempting to ignore caution when things are going well. This is especially true when the economy is robust. Stocks gradually increased during the 11-year bull market, which ended in March. Businesses were easily able to access funding. And numerous professions offered stable paychecks. Many investors made dubious choices about their own finances, since they took dependable positive returns for granted. Warren Buffett once said, "You only find out who is swimming naked when the tide goes out." Before starting, don't forget to like and subscribe to our channel for more future updates. The market plunged at an unprecedented rate over the past few months as the tide violently turned against it. The S&P 500 fell 34% in a couple of weeks, erasing trillions of dollars in shareholder wealth. The lesson learned from this event is that the good times don't endure forever. It serves as a stark warning of the risks associated with deviating too far from a sound financial strategy. A sound investment strategy contains time-tested ideas, many of which have come to be cliched through the years. These investment facts work to keep investors out of difficulty by aiming to prevent financial blunders when times are good, in addition to ensuring that they are on pace to meet their financial goals. Given how many investors are looking for direction during these trying times, this is a great time to review these principles. Number 1. Cash is king. Any wise financial strategy should start with having 3 to 6 months worth of expenses in cash on hand. The people with plenty of money may be in the greatest position as economists and market analysts debate the impact this global coronavirus pandemic will have on the economy. Their cash savings should help them get through these difficult times relatively undamaged if they lose their job or face a big fall in income. Investors who are concerned about their future income would be wise to keep adding to their emergency fund and setting aside additional funds in case the economy's recovery takes longer than anticipated. Number 2. Debt is bad. There are advantages and disadvantages to borrowing money. As many counselors will point out, they are accurate. Leverage can be quite useful under the appropriate conditions. However, individuals who have no debt to anyone are typically those who are in the best financial situation if they don't closely monitor their debt levels. Even the most knowledgeable institutions and investors risk getting into difficulty. There won't be a shortage of news reports about businesses that failed due to their unmanageable level of debt during the coming few months. One of the most powerful financial positions one may be in is debt elimination. Number 3. A clear understanding of your time horizon is key. How much risk one can prudently handle within their portfolio depends on their time horizon. Furthermore, it maintains the challenging market conditions in perspective. If you're a long-term investor, you shouldn't be alarmed by the present bear market. In truth, it ought to energize you. It gives you the fantastic chance to purchase shares of stock at a significant discount from their recent trading price. If you made wise plans as a short-term investor, you shouldn't be alarmed by the current bear market too. Your portfolio should have either been fully invested in high-quality bonds or resting in cash. Given that your investments are not seeing a sharp decline in value, the current economic climate shouldn't have any effect on you at all. Investing without knowing exactly when you need to use the money is irresponsible. Number 4. Dollar cost averaging keeps emotions in check. The process of routinely adding money to investments at regular intervals is known as dollar cost averaging. Every person has strong emotions. Politics can make some people angry, while other industries or a company's business practices can evoke strong feelings in others. The realm of effective investing is not a place where emotional choices should be made. Setting up automated, regular payments to your investing accounts has the advantage of removing emotion from the decision-making process. Your capacity to accumulate wealth over time is increased, and the desire to time the market is eliminated. Number 5. Rebalancing allows you to make money without much effort. Rebalancing is the process of changing a portfolio's weightings as investment prices rise and fall in order to retain the original asset allocation, determined by risk tolerance. Selling the holdings whose value increased while simultaneously increasing the value of the positions whose value decreased is known as rebalancing. In finance, the saying "sell high, buy low" is a cliché. This is a method for carrying it out. Number 6. Diversification is the only free lunch in investing. Investors have a propensity to track down the hottest investment of the moment and invest heavily in it. This is fantastic when everything is going well. But all businesses, sectors, industries, and nations experience cycles. An excessively concentrated presence in one particular region of the market might be disastrous when things go bad. This has been demonstrated historically. The most recent instances being emerging market stocks over the previous 10 years, banking stocks during the Great Recession, and technology stocks in the late 1990s. The greatest strategy for preventing your portfolio from becoming overly specialized on one market area is to diversify across a variety of asset types. While employing such a technique can result in some underperformers, it might also guarantee that your portfolio will also contain a number of relatively high-performing investments. This methodical strategy is a smart technique to survive upcoming market bubbles. Number 7. Markets return to the mean over time. Regardless matter whether they experience extreme optimism or pessimism, markets eventually return to more reasonable, long-term valuation levels. According to this concept, reversion often restores the market to a previous condition, and returns and prices will return to their initial values. Therefore, the following is the easy lesson for individual investors. Make a plan and follow it. Use your best judgment and make an effort to strike a balance between the significance of everything else going on around you. Don't let the market's constant turmoil and turbulence overwhelm you. Number 8. Market corrections don't go sideways. Fast-moving markets frequently have fast corrections, which can make it challenging for investors to calmly determine their next course of action. The key point is to be decisive while trading rapidly shifting markets, and to establish stops on your trades to prevent emotional reactions. Stop orders can help traders in two separate ways. When asset prices exceed a certain threshold, by selecting a certain entry or exit point, they can help investors reduce the amount of money they lose, or help them lock in a profit when prices vary in either direction. Number 9. Conservative bonds have a place in everyone's portfolio. Many investors won't even consider high-quality fixed income during bull markets. After all, there is no need to invest in anything but booming technology equities. The truth is that bonds are an essential component of every investor's portfolio. They offer the psychological advantage of reducing volatility in choppy markets. They provide as a safety net that enables investors to withdraw money from assets without experiencing a significant loss of value due to a market correction. Finally, when equities decline in value and the top-rated bonds rise, rebalancing chances arise. It is unwise to disregard bonds as a key component of one's investment strategy. Number 10. High returns mean a high level of risk. Investors frequently look for the silver bullet that guarantees great profits with no risk. Some people may even believe they have discovered the cure when circumstances are good because their assets keep growing. They quickly learn, though, that large predicted profits could also indicate a higher amount of risk when the economy shifts. Leverage, illiquidity, and bad credit are only a few examples of the risk's numerous manifestations. The bottom line is that you must be willing to assume a high level of risk if you want to have a chance of earning high returns. It's critical for investors to approach every opportunity with a clear mind. Number 11. Boring over exciting could be the right approach. Investors frequently mistake a promising financial opportunity for an intriguing notion, the newest trend, a special offer, or a strategy that claims to outperform the performance of the S&P 500 can all cause excitement. More often than not, these opportunities are being marketed on marketing hype rather than actual merit. Stick with basic, uninteresting investments as a strategy if you don't want to be drawn into one of these circumstances. This might include a mix of high-grade bonds, index funds, and blue-chip equities. An investor could miss the next popular IPO, but they won't fall for the next Ponzi scheme either. Number 12. Once you win the game, stop playing. The stock market may become addictive, especially if you've built up a sizable amount of cash over the course of your investment career. It's critical to realize that the fundamental goal of investing is to help one reach their financial objectives. There is no incentive to continue putting that money at risk after the investor hits that magic amount. Granted, the wealth should be invested appropriately, if there are multi-generational goals that will not be achieved for several decades. However, the money that has already been saved up to support an investor's lifestyle may be transferred out of stocks. Investors who have arrived at that stage are in the fortunate position of no longer having to worry about the coming bear market. A severe market downturn does have one benefit, though. It makes investors think back on their choices from the high times. If investors gotten off track, it might be disastrous and financially ruinous. But if they adhere to the fundamentals, their prospects of long-term success should rise. This is it for today's video. What do you think of our video? Feel free to share your thoughts in the comment section below. Don't forget to like and subscribe to our channel for more future updates. Thanks for watching.